All right, welcome to the Explainer. Today, we're going to tackle a three-letter acronym that you see on receipts pretty much all over the world. It's a tax that affects almost everything we buy, but for a lot of us, it's still kind of a mystery. Yeah, we're talking about VAT.
You've definitely seen it, right? That little line item at the bottom of a bill from a restaurant, a shop, a service you paid for. It's a tax you pay constantly, but how it actually gets from your wallet to the government? Well, that's a pretty fascinating journey. So what's the deal with it?
Okay, let's start with the absolute fundamentals. Before we can even get into why more than 160 countries use this thing, we need to have a really clear idea of what a value-added tax actually is.
So, that's the official definition, and yeah, it's a bit of a mouthful. Let's just unpack that. A general tax on consumption. That just means it applies to most of the stuff we buy. Exactly proportional to the price. That's simple too. The more something costs, the more tax you're going to pay. But here's the kicker. The really crucial part is that last bit, whatever the number of transactions. That little phrase is what makes VAT so different from a simple sales tax, and it's the absolute key to understanding how this whole system works. To really get a grip on this, we're going to follow a single product. We're going to trace its journey from the moment it's made all the way until it ends up in your hands. And we'll see exactly where and how the tax gets added at every single step. So we'll keep it simple with a 4-stage supply chain. It all starts with the manufacturer. Then it moves to a wholesaler who sells it to a retailer. And finally, the retailer sells it to the consumer. At each of those first 3 stages, value is added, and that's where a piece of the tax is collected. Okay, stage 1. Our journey starts here. A manufacturer makes something and sells it to a wholesaler for $100. We'll just say there's a 10% VAT rate. So the manufacturer adds $10 of VAT to the bill, collecting $110 total. That $10 is called the output VAT. Now, because the manufacturer is at the very beginning of the chain, they didn't pay any VAT on raw materials, so their input VAT is 0. Easy enough. They send the whole $10 to the government. Now watch this, because this is where the magic of the whole system comes in. It's called the credit mechanism. So the wholesaler sells a product to a retailer for $150, adding $50 in value. They collect $15 of that on that sale. That's their output VAT. But, and this is the important part, remember they already paid $10 in VAT to the manufacturer? That's their input VAT, and they get to claim it back as a credit. They just subtract the VAT they paid from the VAT they collected. 15 minus 10 is 5. So they only send $5 to the government. See? They only pay tax on the value they added. And the pattern just keeps on going. The retailer buys the product for $150 and sells it to you, the consumer, for $200, again adding $50 in value. They collect $20 in VAT from you. But, just like the wholesaler, they get to claim a credit for the $15 in VAT they paid. So once again, they only send $5 to the government. And boom, this is where it all clicks. The government got $10 from the manufacturer, $5 from the wholesaler, and $5 from the retailer. Added up, that's $20. And what did you, the final consumer, pay? You paid the $200 price plus $20 in VAT. It matches perfectly. The crucial thing to get here is that while all these businesses are collecting the tax in little chunks, the entire financial weight is just systematically passed down the line until it lands squarely on the final consumer. This system seems kind of complicated, right? All these steps and credits and invoices. So you gotta wonder, why have so many countries adopted it? Well, it turns out this step-by-step method has some huge advantages, especially if you're a government. First and foremost, that is an incredibly effective way to raise money. It's an absolute cash cow. Just look at the data. Over the last few decades, countries all over the world, from New Zealand to Sweden, have become more and more reliant on these kinds of taxes. VAT is without a doubt a massive and growing source of government revenue. But why is it so good at what it does? Well, for one, it's kind of self-enforcing. For that wholesaler to claim their $10 credit, they need a proper VAT invoice from the manufacturer. This creates a paper trail that basically encourages every business to report everything accurately. Second, it's great at taxing imports, a huge source of money. In some countries, up to half of all the VAT they collect comes from imported goods. And finally, because it taxes just general consumption, it has a really broad and stable base. It's like a steady, predictable paycheck for the government.
And this quote from the IMF's Milka Casanegra just hits the nail on the head. What she's saying is that how you collect a tax can be just as important as the tax itself. And the way VAT is structured, with that built-in paper trail, makes it an incredibly powerful tool, especially in places where enforcing taxes can be a real challenge.
But, of course, it's not a perfect system. Not by a long shot. Bringing in a VAT system and then running it comes with its own major set of headaches. And if you get it wrong, it can cause huge problems for everybody. For one thing, it's just complex. Businesses have to track all this input and output tax, which is a lot of paperwork. And governments have to process millions of these returns and, this is key, refunds. See, if a business pays more VAT than it collects, like an exporter for example, the government owes them a refund. And if those refunds are delayed, it can create serious cash flow problems. That whole refund process also, unfortunately, opens the door for corruption and even really sophisticated crimes like carousel fraud, which are basically elaborate scams to steal VAT money. And this quote shows you exactly what can happen when a rollout is botched. When Guatemala tried to introduce VAT back in 1983 without much planning, the result was total chaos. People were confused, they resisted, and the government actually had to cut the tax rate just a few months later. It's a huge lesson that with VAT, how you implement it is everything.
So, after all that, the mechanics, the pros for governments, the challenges, let's bring it all back home. What does this global tax system really mean for you, the person who's actually paying for that thing at the end of the day?
And if there's one thing you remember from all this, let it be this. While all the businesses in the supply chain are acting like tax collectors for the government, the entire financial burden of the tax is designed from top to bottom to be passed on until it rests with one person, the final consumer, you. You're the one who ultimately pays the full amount. So, to make this crystal clear, let's just quickly compare it to a retail sales tax, or RST. An RST is collected just once, right at the very end when the consumer buys the product. A VAT, as we've seen, is collected in little pieces all the way through the process. For a government, collecting it in stages is way more secure. Think about it. If one business in the chain goes bust or cheats, the government has already collected most of the tax from all the previous stages. So we're left with this really interesting trade-off, aren't we? VAT is an incredibly robust, efficient system for governments to raise money, no doubt about it. But because it's collected piece by piece and often just baked right into the shelf price, it's less visible to the people who are actually paying it. So the question is that efficiency for the state worth the lack of transparency for the citizen? That's definitely something worth thinking about the next time you glance at your receipt.